In this example, we are looking at the multi-step income statement. The multi-step income statement is going to use the same information on a single-step income statement, only it's going to put it into a different format. And it's going to consist of multiple steps that enable us to get to our bottom line, the net income. So we're going to start off with the information of all of our revenues and all of our expenses. And the first thing we're going to do is, unlike the single step income statement where all of your revenues are at the top and all of your expenses are at the bottom, we are now categorizing our revenues and expenses into revenues and expenses that pertain to the operations of our business, the day-to-day ongoing reason we're in business, and then our other category is actually going to be called other revenues and expenses, and it's going to be where we can earn revenues or incur expenses on things that do not have anything to do with the day-to-day operations of our business. So generally in that category, you're going to see revenues that are earned from maybe other investments that we have, and that money is generated through those investments and not from our day-to-day operations. And then we have expenses, other expenses that can be incurred, such as the cost of borrowing money, which would be our interest expense, the interest they charge us to borrow money, the bank that is. So at the beginning, we are going to start off with our net sales, because in this scenario it provides us our net sales of $4,800. So although we have two revenues, net sales and interest income, our net sales are the only ones that are part of the operations of our business. So then we take our net sales and we subtract out our cost of goods sold. Now our cost of goods sold are going to be all the costs and expenses that are incurred that have to do with the product that we are selling. So our cost of goods sold is $1,680. So revenues minus expenses, net sales minus cost of goods sold, gives us our gross margin. So you calculate gross margin by taking the $4,800 you have earned in your net sales minus your $1,680 of cost of goods sold, and we come up with a gross margin of $120. But we're not done. That's our gross margin just on the product itself. The cost of good is what we paid for the product that we sold, and then the sales is the money that we earned when we sold the product. So then we have operating expenses. So operating expenses are going to be the expenses that go along with the day-to-day operations of our business. And now we're going to take those operating expenses and we're going to separate them out into two different categories. We have selling expenses and then we have general and administrative expenses. So our selling expenses are going to be all the expenses associated with actually selling the product. In this example, it just tells us our selling expenses are $1,110. And then our general expenses are $900. So our total operating expenses are the $1,110 plus our $900 of general, which is $2,010. So then we can calculate our income from operations. It's not going to be our overall net income, but it's going to be the income that our company earned from the operations of the business. So we take $3,120 minus our $2,010, and we come up with income from operations of $1,110. Now there are other revenues and expenses in the business, and those are going to be in their separate category. The purpose of providing these different categories is so we can look at the quality of our earnings. We can look at the bottom line, but investors and outside entities might want to know, well, where did that income come from? So by doing it this way, you can see that, well, $1,110 of our income came from the actual operations of our business. So then we're going to look at other revenues and expenses. So under our other revenues and expenses, we have interest income, and our interest income was $180. And then we have less our interest expense, and our interest expense is $420. So one of the first things you should notice right off the bat is that our expenses are greater than our revenue by $240. So the difference here is going to be $240, but the question here is, do I add it or do I subtract it? Well, since the greater amount was expense, I'm going to have excess of other expenses over other revenue because my expenses were greater. If my revenues were greater, I would have excess of revenue over other expenses. And since my expense was greater, I'm actually going to subtract out that $240 from the $1,110, and my net income is going to be $870. So if you were to look back at the previous example, SE2, we have exactly the same net income and exactly the same figures, only this time we're putting into the multi-step income statement, where in step 1 we calculate our gross margin, and then in step 2 we calculate our income from operations, and then in step 3 we calculate our other revenues and expenses, and then in the final step 4 we calculate our net income.